This is a stock analysis for Lloyds Banking Group. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. Now, 6 months ago, I did a video on UK banking stocks, and the three which I'm left with now are Lloyds, Barclays, and NatWest. Out of interest, HSBC Holdings didn't get through the first screening because they've got a massive exposure to China. And the best on this shortlist was Bank of Cyprus. Although I bought some early this year and got a really nice 30+% return, unfortunately they delisted to move to the Greek stock exchange. So we're left with Lloyds, Barclays, and NatWest. So I'll be starting off by looking at Lloyds. They're the UK's second largest bank with over 27 million customers. They're mainly retail and commercial banking. This pie chart here is their underlying pre-tax profit by business segment. Their insurance and pensions division, although it's only a tiny slice of their pre-tax profit, is actually a substantial part of their business. It's just that the pensions and insurance aren't doing very well at the moment. So they have a large insurance and car finance exposure, and this does differentiate them a bit from Barclays and NatWest. Of course, they have systemically important institution status. They've got a policy of paying out 30 to 50% to shareholders, and currently they're yielding a 5% dividend yield plus 2 billions worth of buybacks, which is a feat they've accomplished every year the last 4 years. So as we found when I did the stock filter video, Lloyds have got one of the best net income histories actually compared with the others, and also one of the healthiest capital ratios. So the retail part of the business, that obviously includes mortgages, credit cards, personal loans, and motor finance. Whereas commercial banking, this will be more business loans, providing working capital, as well as working capital for large corporates and institutions. Down here, I've illustrated the rather exciting history of Lloyds. They took over TSB in 1995, which enlarged the group quite a lot. Then in 2000, they bought Scottish Widows, and this is what gave them this big presence in insurance. Now, before the great financial crisis of 2008, Halifax and Bank of Scotland merged in 2001 to form HBOS. Now, actually, HBOS were extremely poorly managed, and they had lots of really dodgy assets within them, so that when we had the big financial crisis, this company was just completely destroyed. And it was under those circumstances, with HBOS on the verge of bankruptcy, that Lloyds took them over in 2009. Now, actually doing poor due diligence of HBOS before they took them over, because after taking them over, the losses and stuff were a lot worse than previously thought. And even if it was kind of via the subsidiaries, Lloyd's got a lot of government help during the great financial crisis. If you look here at the shares in issue, you see that following the HBOS acquisition, there was a 10x roughly in the number of shares, and then that kind of doubled again. And a lot of that, I believe, will be because of all the government bailout issuances. And you can see this play out in the share price for Lloyd's, where obviously after the big great financial crash, the share price went down considerably. And so obviously this is a combination of the lower performance of the bank and the greater risk of its assets, combined, of course, with its number of shares in issue diluting the stock considerably. You'll see that one thing that pointed me towards banks in the first place is where we have this long-term low price, which is something I like to look for, and it seems to have broken out of this technical pattern that I observed. And we get the same interesting pattern with the other banks. So here's Barclays, for example, and you see exactly the same pattern. So to try and understand Lloyds, I've first of all, let's start off by looking at the different different business segments and the underlying pre-tax profit. And we see that actually retail features highly there, as does increasingly commercial banking. And the actual insurance part of the business, which is this here, it used to be more substantial, but now is kind of whittled away to almost nothing. Unfortunately, it used to be that you could get a good idea of these different line items with regards to the income. However, ever since the ever since 23, they've had to adopt new IFRS reporting standards, and this means now that you've got this line item here, finance income, insurance, and investment contracts, and that's flapping all over the place by 20 billion every year. The net trading income then flaps around kind of opposite that, and then you end up in a kind of equivalence to the more sensible numbers we would have had before. However, it basically makes it fairly impossible to decipher what the hell is going on here. And visually you can have a better idea, and I've visualized that data here. So obviously, ever since these new IFRS standards, the insurance claim somehow gets absorbed into these numbers flapping around all over the place. So that kind of makes the expenditure easier to understand. But then up here on the income, rather than having this nice separate insurance income, that gets absorbed into all this magic here. And I've put this financial income, insurance, investment contracts. I've put that these orange bars here. So you do actually now get a final income which you compare with the expenditure, and you can see whether that was a negative or a positive. According to these numbers here, as you can see, as I've indicated with the arrows, and then you get like the final number represented here. But it's a real mess. It makes it practically impossible to understand where the money's coming from. Although I've kind of done my best here, what I have to say right from the start is that because of these IFRS reporting standards, I find Lloyd's difficult to understand what's going on. And so that's basically a reason to not invest in them, because it's hard to work out what's going on in terms of their income statement. Now, actually, this is fairly unique to Lloyd's, and the reason being is that the other banks don't have much of an exposure to insurance, whereas Lloyd's have quite a massive exposure to insurance. And unfortunately, because of that, that forces them onto this weird reporting. And what I think's happening is that if you do loads of insurance, particularly life insurance, then you need to invest in lots of bonds. And under these new standards, you have to report how much all these bond portfolios have gone up and down in value. I think it's something like that. Correct me in comments, please, if you disagree. But something to do with the insurance means that, unfortunately, because of the large exposure to insurance, it kind of makes the profit and loss statement too hard to understand as far as I'm concerned for Lloyd's. So carrying on regardless anyway, it's also good to look at the assets and liabilities to help understand how a bank functions. Now, the liabilities, and yet again, look, there's a big chunk coming because of the insurance exposure, but still, the majority of the liabilities, they are actually customer deposits. And so we see a breakdown up here of the customer deposits, and 441% are actually savings accounts, with 22% current accounts that pay barely any interest, and then 35% commercial banking accounts. So actually, the most that these will be paying will be something like 4% interest, and actually a lot will be paying barely any interest. And then over on the asset side, this is loans that the bank has lent people. And actually, the bank creates these out of thin air. They essentially print the money out of thin air and lend it to people. Now, the majority of this is actually for mortgages, but also this would include things like credit cards, business loans, etc., etc. So the basic concept of how a bank works is they have people's money deposited because everyone is forced to deposit money they have in banks because that's the legal tender, because the government has a monopoly on violence. So you're forced to use a bank because you're forced to operate in pound sterling in the UK. The banks give you low, if any, interest on that, and then the banks create money out of thin air, lend it to people, and charge a higher interest, and then you get a nice arbitrage between the higher interest for people mortgaging houses and lending money on credit cards and things, compared with the low interest they have to pay for the people who are forced to deposit their savings at the bank. So that's obviously the basic concept of how a bank works that we can see here. Now, obviously, there is a component of cash at central banks, which the banks actually do get interest for at the base rate. And there's also the financial assets at fair value, which I think relates to, it might be things relating to their insurance and pensions. I'm not sure. So really, the most critical aspect is the loan book of the bank. And here we've got here we've got pie chart of their loan book, and a certain percentage of what are called stage 3, which is where the people they've lent the money to can't pay their interest anymore, and you've essentially given up on the debt. So I've keep track of. It's interesting to see, first of all, that the majority of their loans are actually for mortgages. So you see how important so you see how important the housing market is to the economy. And then here we see then the how much is corporate and institutional loans and SMEs, etc. So it's interesting that so I've picked 2019 as a good reference year because this was before all the COVID nonsense started. And then this here is actually for 2024 Q3, and then the box before it is the 2023 full year. So you can see any more recent changes. And it's interesting that before COVID, actually the commercial companies, the large institutions and corporates were actually struggling a bit with a 4% stage 3 rate. And the credit risk is reduced now to a very low 1%. Meanwhile, small medium enterprises, they were doing okay before COVID, but following the government's decisions over COVID, these are now extremely distressed at 4%, dropping, however, from 5% at the end of last year. And mortgages are kind of reassuringly low in terms of how much are distressed, at only 2%. So a very interesting trend there as to what happened over as a result of the COVID period and how it seemed to benefit big corporates and punish the little guy. That's very interesting. And also, however, the most important thing is we've got to keep an eye, obviously, on the SME, but generally, it's not very distressed at the moment. But this is obviously an important metric to keep track of if you are investing in a bank stock. And here we've got the stage two assets. These are assets that are kind of people have started missing payments, but they're not written off yet. Whereas the stage three assets are the ones definitely written off. Uh, Pay attention to the scale. This one only goes up to 6%, where this one goes up to 25%. And it's interesting that you can see how, and the most interesting trend really is the commercial SME. You can see it really has got quite distressed since 2021. The mortgages are fairly stable. An interesting thing is that actually you kind of want things, so particularly credit cards, you want them to be have a highish stage two, so that there's a lot of people paying fees for not paying their interest on time, and have been maxed out on lots of cards, paying lots of interest. But you want it to be minimally stage three. You want people getting extorted to the maximum in terms of paying high fees for paying high interest for money that they borrow, but without them actually going broke. And so you can see some like interesting trends in that regard. So if we went through a difficult period for a couple of years, but there wasn't a total recession, that will actually be good for the banks, because they'll have more assets in stage two, without they'll have higher returns from more stage two, with lower defaults from lower stage three. And so really there's two metrics actually, which are the most two important metrics for how much a bank is going to make. One is the net interest margin, and the other is the loan book. Now, interestingly, net interest margin has stayed fairly stable for retail. And actually, here I've gone back to around the time of the credit crisis. And what I found, if you go all the way back then, is the net interest margin, regardless of what interest rates are, even if they're high or low, for retail, it tends to stabilize at around 3%. So it's interesting because regardless of interest rates, their net interest margin for retail stays about the same at roughly 3%. However, for commercial, it seems to have increased, and that makes sense because large corporations and commercial large businesses, they are in the debt market, and that's where yield curves come into play. Obviously, because currently it's expensive for the government to issue gilts, and we've got a high yield at the long end, that will mean, I think, that when banks lend money, and banks can lend businesses money. I don't know. I've certainly seen numbers like 10%, sometimes numbers like 5%, depending on the circumstance. But they will lend them. They basically get a higher net interest margin, and if the yields on bonds are higher, then that means banks are going to get a higher return as well. So we do have this very interesting phenomenon here, where particularly the commercial side is going to be doing well in the conditions we're under at the moment. And what we want to see is the net interest margin staying at about 3% for retail, staying above 4% for commercial. But then the other parameter is the loan book, because obviously the bigger the loan book, the more return on interest the bank's going to get. And so these are the most critical parameters for understanding how a bank's going to make money. And we see that it's looking kind of positive, a bit stagnant, mainly a bit stagnant perhaps for commercial loan book. But what I'm looking for is, I'm expecting the US economy to take off next year, I'm sure the UK will lag behind that, but eventually, once the UK economy does start to take off, we should see the banks lending more money to people, even at these higher interest rates. And then that's how they start bringing in substantially more money. And remember, this is how they'll be loaning out that money, mostly mortgages, but potentially the growth will come more from the commercial and corporate side, actually. Okay, so now I'm going to have a look more closely into the retail and commercial banking. Obviously, because of the reporting, it's very difficult to understand what's going on from using the profit and loss account. However, Lloyds do prepare a underlying results for each business segment. So from looking at each in piecemeal, I've actually found it more possible to try and work out what's been going on. And so starting with retail, and first of all, if we look here at the retail loan book, we really see that the vast majority of their loan book and of this part of the business is mortgages. However, perhaps 5% of it is UK motor finance. Now we see that the most of the income is net interest income. So that is essentially how big their retail loan book is, which is mostly mortgages, times their net interest margin, which seems to stay stable at around 3%. And that is the biggest portion really of this business. However, it's a little bit disappointing that the operating costs haven't really reduced. And overall, this black line shows you the net result, which is kind of good numbers compared with the past, but kind of a bit stagnant for retail. A big reason for this is because they've spent a lot of money investing in woke ideas, particularly EVs. They bought Tuskers, and they just went totally big on leasing EVs to people. And of course, what happened was they acquired Tuskers 2023, and of course, the last couple of years, all we've heard about EVs and hybrids is how they're losing all their value on the second-hand market. And so, because of this, as you can see, as operating lease depreciation, Lloyd have took down massive, and we're talking over 1.5 billion in write-downs, a lot of which is related to that. Okay, so next to commercial banking, which isn't as big overall as the retail, but as you can see from the black line here, it's the strongest performing part of the business at the moment. And you can see that as we've gone from 2022 to 2023, the net interest margin has increased significantly. And then this insurance, pension, and investments, as you can see, it's whittled away to near nothing. And as well as no longer really contributing anything, this is a real pain in the neck because of the way it makes the income statement difficult to understand. Plus, with what's happened with the bond markets and things, I'm not sure it's good to be in insurance at the moment. So here we've got the history of Lloyd over the last 5 years, and to be honest, not all that much has happened. I guess it's a boring bank. Apart from they bought Embark, which I believe is something to do with online investment, so it was kind of for their high affluence business. And then they bought Tuskers, which obviously was because they were hell bent on going full EV for political purposes, but unfortunately that's caused complete chaos. And then, as well as all the cars that they bought losing all their value in the last few years, They then got hit by this car leasing scandal, and you can see how the share price crashed last week. And this was because it was announced that they were going to get hit hard by this car leasing scandal. Now they'd actually put aside $500 million for that in 2023, but now it's thought that the total cost could be up to $1 billion. It's probably going to be between 1 and 1.5 billion. So a real nasty hit. So looking at the profit and loss, well, obviously you get caught within the thick weeds as soon as you try to look at the profit and loss. But to focus in on the just the net income, you can see that, really generally compared with before the credit crisis, um, they're doing well, and actually really post-COVID crisis, doing well at roughly 6 billion a year. We're expected to underperform that a bit this year. These are the Q3 numbers, but still generally kind of good, even if not up this year, despite all the nonsense with the insurance and the car leasing. Actually looking fairly good. And here I've got a graph of the net income history, and what I like to see is what we've got here. You've got a lovely widening gap between income and expenditure. So the net income is in a very good positive trend for Lloyds. You have to give them that. In terms of their assets and liabilities, now obviously I've gone through that in a pictorial way already, but just looking at the numbers to eke out any patterns, I've noticed a significant reduction in the cash at central banks, which is kind of a bad thing in one way. But I believe, and please tell me in comments, people, what you think, but I think that there may be new, according to the latest kind of banking regulations, the capital ratios have been relaxed a bit, and so that means that the banks don't have to keep so much reserves at the central bank, and so that could explain why the cash at central banks is reducing. Other than that, there's not really much to talk about. And on the liability side, no particular trends that I can pinpoint there. So that brings me to the equity and valuation. And you can see that the loan book that Lloyds have is way above the market cap and everything else. So I've took away, so be aware of that, but I've took away the loan book, and then down here we can focus on these things. And actually, when you compare with before the crisis, the first thing is the market cap is up considerably from then, but then so is the loan book. And actually, by the way, the purple line here, this is the data starts at 2007. So in 2007, we had a loan book that was roughly half of what it is now, and the market cap was roughly half as well. The reason why the loan book increased so much, and actually why the market cap kind of looks outsized, was largely because of the HBOS takeover, which massively increased the stock dilution. And then, of course, the government bought a load of shares, again increasing stock dilution. So that was why we got this absolutely horrendous drop in the share price around that time. Actually, when you compare the share price now with 15 years ago, Lloyds and all the other banks look undervalued to me. I mean, the market cap before was well above the net assets. Now it's significantly below the net assets with a price to book of zero point 0.7. When we look at the non-performing assets at stage 2 and stage 3, we're in a kind of healthy amount at the moment at 12% of the total loan book. But the amount actually in default is very low down here. Compare that with 2009, where the amount in default was all the way up here, you see? So the situation between now and credit crisis is extremely different when you look at the orange line here of stage 3 defaults. It's night and day difference. For me, I really am wondering if the bank stocks, which have been unfashionable for a long period of time, are undervalued, even when you look at um, Lloyds with all their problems. So for me, I don't see why the market cap shouldn't be higher to meet the net assets. Then on top of that, I've done my crude calculation of how much income we can expect in the next 5 years, where I applied a discount rate which assumed roughly 5% inflation, and I assume no growth in net income. And even with that number, which is probably being fairly conservative, well, that again, when you include this, this stock looks undervalued to me. I've been looking at some commodity companies, and these commodity companies and also oil companies, they are very conservatively valued, and normally the market cap is equal to the net assets plus the expected NPV 10 over the next 5 years, for example. Now, those are considered, versus tech stocks and things, those are considered extremely conservatively valued stocks. So if I apply that same logic to these bank stocks, it's perfectly reasonable for the share price to go up to meet the net assets and then go up even more to take account of the earnings. And so, yes, from this graphic that I like to produce, for me, not that I'm an expert or anything, but for me, they do seem undervalued to me. Okay, finally, look at the shareholders, and obviously, with them being such a huge company, um, Harris Associates at 6%, BlackRock at 6%, but none of the other shareholders, none of the other big institutional shareholders um, have enough for them to have to report because it's such a big company. So not really much we can eke out from looking at the shareholder data in this case. So this completes my analysis of Lloyds Banking Group. I don't like Lloyds because they've got because they've got too much of their businesses associated with insurance, and that then makes their income statement too awkward for me to get really properly feel like I understand them. Also, they've been investing heavily into electric vehicles, and that's causing them all kinds of hell because they're having to write down billions in these cars just becoming worthless as soon as they bought them, because that's what seems to happen with EVs. Also, this car leasing scandal. This is another reason for me to not invest in Lloyds. However, I have invested in Barclays and NatWest, and I'll be doing videos on them soon in the future. I myself am bullish on the banks, and I'm targeting them to kind of double in value, I'm targeting them to double in value in the next year or so, based on these stocks are just coming into fashion now with the investors, as you can see with this long-term trend, having been hated for many years. And I think they have to double in value for them to, now that they're in fashion again, actually for their market cap to exceed their net assets, and then also to take account of the future revenues that you can expect to come in. Now, this thesis I have into investing on bank stocks, it has certain assumptions which I'll be able to monitor as time goes on. One is that the bond yields stay high at the long end. So I'm not expecting interest rates to drop much more than they have, but I'm expecting, because of the government's mismanagement of the economy, very high public sector in the UK, and the fiscal indiscipline of the government and previous governments, I'm expecting the bond yield to stay high on the long end. This, I think, will be good for the net interest margins in the commercial business segment for the banks. I'm also making the assumption that house prices don't crash, because if they do crash, that's going to be very negative for the banks. And so I have to monitor that. Also, I'm expecting that our economy will be kind of a bit stagnant in 2025, like it has been this year. I see the US taking off next year, and I'm sure there'll be a lag, but I'm sure that the UK economy will take off. And so the interest rate situation, if they stay fixed as they are, which I'm kind of thinking they are, as a kind of base case assumption for my investing, then we can see, as long as the net interest rates stay above 2.5% for retail, 4% for commercial, then my hypothesis here still stands. And if I want to see, as the economy starts to take off, I want to see the loan book increase for commercial and retail. And so these are then the 5 things that I'm going to be keeping track of to test whether I'm still investing in the banks for the right reasons. So that completes my video for Lloyds Banking Group. Please remember, again, I do this just for fun, as a hobby. Wish you the best of luck with your own investments, and keep safe. I do videos like this one just for fun, as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.